Hello and welcome to CNBC On Assignment. I'm Ritika Gupta, and over the summer I've been reporting on the UK's economy, taking a deep dive into everything from house prices to a growing wealth exodus from the country. But we begin with a look back on 1 year of a Labour government. Labour won the 2024 election in a landslide victory, but the party has faced plenty of challenges in their first year in power. Trade deals with the US, India and the EU won the government praise, but attempts to reform the welfare system were dropped after internal opposition. Prime Minister Sir Keir Starmer and Chancellor Rachel Reeves pledged to deliver strong growth to the UK economy and fix the public finances, but those promises are yet to materialise. I took a closer look at the Labour government's year in power.
We said we would end the chaos, and we will. We said we would turn the page, and we have. Today we start the next chapter.
It's been 1 year since Labour's return to power here at Westminster, and after a landslide victory, it appeared that the party had turned over a new leaf after 14 years in opposition. But it's been nothing short of tumultuous for Prime Minister Sir Keir Starmer. Big promises, especially on the economy, have failed to materialise, and as a result, Starmer's popularity has plummeted in the polls. Chancellor of the Exchequer, Rachel Reeves, vowed to fix public finances, but her pledge to rule out both tax rises on working people and any increase in borrowing left her in a difficult position. Ultimately, the reality has been a series of U-turns on welfare and spending cuts in her spring statement, and even speculation about whether she will be in the job by year-end. With little room to manoeuvre, senior economist at the Resolution Foundation, Simon Pittaway, now sees a rising prospect of fresh tax hikes in this autumn's budget.
As far as we're concerned, sticking to the existing fiscal rules is really crucial. That's a move that would signal kind of credibility and confidence to the market. Depending on the government's priorities, some combination of higher taxes and lower spending out towards the end of the forecast period might be the way forward.
Domestic issues aside, where Labour has arguably had more success is on the international stage. The government delivered a triple whammy of trade deals with India, the US and the EU. While many political commentators have hailed these developments as major breakthroughs, the overall economic impact remains to be seen.
I think the reset of relations with the European Union is important, a long way to go with that, but that sets us back on a sensible track. And I think he has managed this incredibly difficult task of working with President Trump really quite adroitly. We have the trade deal, and it's been trumpeted as a historic trade deal. I wouldn't call it that. It's essentially limiting the damage that Trump would have done otherwise to our trade.
But it hasn't been enough to get Labour's ratings back on track. Keir Starmer's popularity with the public fell to a record low in May, according to a YouGov survey. At the same time, rival Reform UK is gaining popularity. Recent polling shows that Nigel Farage's party is on the way to get the most seats if an election took place this year.
What the rise of Reform, I think, illustrates is the level of disaffection with politics and political outcomes. This should be redressable by good policy making, good, honest policy making, but it will take time.
As bad as the outlook may be for Labour, with another 4 years until another general election, Starmer may still have time to turn the ship around. Since the UK's Labour Party came to power last July, the Chancellor has faced criticism that changes to the country's tax policies could lead to an exodus of the ultra-wealthy. But hard data is not yet backing up that trend. I explored the significance of these warnings for the UK economy. Since the UK government's crackdown on the mega-rich, there have been stark warnings that an exodus of London's wealthy is underway, despite a lack of hard data to back it up. At the heart of the complaint are changes to the tax system, in particular the abolition of the non-dom regime, which allowed wealthy foreigners to avoid paying tax on earnings outside the UK and avoid paying inheritance tax on their global assets. Former CEO of Barclays and now CEO of 10x Banking, Anthony Jenkins, warns of the knock-on effects to the economy if people flee to lower tax jurisdictions like Dubai, Monaco and Singapore.
We know that the top 1% and the top 0.01% pay a very high proportion of taxes in this country. So the tax base starts to shrink. That's one thing. The second thing is you lose the benefit of the money that they spend in the economy. That's not just about people that they employ, but it's also about things like philanthropy. And the third thing, of course, is what we really need most of all in this country is people to start and grow businesses. And that means we have to be an attractive location for capital. For starting businesses, we need that entrepreneurial climate here.
There are even warnings that Labour risks taking Britain back to the challenges of the 1970s, notably under then-Chancellor of the Exchequer, Denis Healey. At the time, a high tax and anti-business environment led to Britain experiencing thousands of people leaving the country, often referred to as the brain drain. Adding to the uncertainty is whether the current Chancellor of the Exchequer, Rachel Reeves, will introduce further tax changes in her upcoming autumn budget, such as a potential wealth tax. However, claims of a mass exodus of wealthy non-doms in response to tax rises may be overblown. Initial tax data suggests the number leaving the country is in line or below official forecasts from the Office for Budget Responsibility. Andrew Wishart, economist at Berenberg, says it's going to affect some parts of the economy more than others.
That is going to affect sort of the most luxury-orientated firms. It's going to affect the top end of London's property market as well. So there are going to be pockets that are quite severely affected by this exodus. However, for the UK economy as a whole, that's a very small part of the pie. I'd say perhaps the bigger issue going forward is that if these people, a lot of whom will be entrepreneurs, setting up businesses in the future, it's less likely that they're going to locate them in the UK. But their existing businesses, their existing interests, I think they're still likely to sort of service here, visit the UK, even if they're not based here full time. So I think it's sort of a small drag overall, but sort of a bigger hit to some of the sort of luxury sectors and the top end of London.
Still, the UK is only set to publish an estimate of how many non-doms left the country due to the new rules in 2027. Those figures will certainly intensify the debate. From fiscal to monetary policy, the Bank of England cut interest rates to their lowest in more than 2 years in August to 4%. After a deadlock forced the Monetary Policy Committee into an unprecedented second round of voting. I spoke with the Governor, Andrew Bailey, about inflation and the uncertainty surrounding future decisions on monetary policy. You had 2 votes for the first time, so that's very unusual. Yes. It's unusual to have this level of division. So why do you think that is, and how are you weighing up the arguments at either side of you?
I think the voting actually reflects what a finely balanced situation we're currently in terms of interpreting monetary policy and particularly the things that are the drivers behind it. So in a way, I think the vote is a very accurate reflection of the finely balanced decision that we had to make. Now, of course, it's important that we have a clear decision, and that's exactly what we did have. We have processes that take care of that, and we did it. But I think it's just a reflection of the fact that we're in a finely balanced situation.
And what exactly do you mean by finely balanced when we come to the language of it? Because there's an interpretation of whether it's symmetric, that at every meeting you either cut or don't cut and it's finely balanced, or is it described as to whether you even need to do quarterly rate cuts?
So I continue to think that the path will be further downwards, but I think we have got more uncertainty about the course, precise, if you like, course of that path. So I think there is more uncertainty about exactly what we'll be doing at the meetings immediately to come, for instance. I think that's a reflection of the situation we're in. And if I could just briefly describe that situation, I think there are risks on both sides of this. Now, I think on the sort of the upside, the higher inflation side, I think we've seen a bit of an increase in inflation. We always thought we were going to get into this, what we tend to call the hump of inflation, but much lower than we had a few years ago, to be clear. We're not in that world at all. Now, we've seen a bit of news, not a lot, but a bit of news on that front. I think the risk on that side in terms of inflation is a bit higher. But look at the other side. We've seen some further weakening, I think, in the labour market. We haven't seen a lot of news on sort of overall demand in the economy relative to what we thought it would be, but we've seen a bit of news, I think, on the labour market. Pay has actually come in under where we thought it would be. I mean, the level obviously was high, but it is now coming down, and it's coming down faster than we thought it would. And of course, there's a risk therefore on the downside, which is more to do with activity, but that obviously activity feeds through into inflation. So yeah, we could see a rather weaker outlook for inflation. And we have to balance those two things. And I say they're moving in different directions. There's an upside risk to inflation, and particularly as to whether this current increase could persist a bit, somewhat more than we expected to. We don't expect it to actually, but could it? But there is that has to be set in the context of particularly in the labour market conditions, which appear to be softening.
So how are you assessing the labour market? Because there are different reads when you look at the data.
Yeah.
We're seeing unemployment clearly moving higher. But how confident are you that this is going to feed through into prices, into disinflation and activity down the line? And what signs are you looking to gauge it?
Well, it's a very challenging, it's a really good question, thank you, because it's a very challenging read, because we have to look at both demand and supply in the labour market. So in other words, what's the demand for labour, and is it softening? And I would say yes, it is. And I spend a lot of time going around the country talking to businesses, and I do pick that up quite consistently, that their hiring intentions probably are getting a bit softer, for instance. It is feeding through into pay settlements, I think. They're coming in much more where we thought they would, but some of that downside has come down, and over the course of the last few months, they've been a little bit weaker than we thought they would be, even though I think by the end of the year, we think they'll probably end up in about where we thought they would. But that's a bit on the downside. But then you have to set that against what's the overall situation for the supply of labour? What's participation in the economy? And that's hard, because the data are not as robust as we would like them to be at the moment, to be honest. We have seen a decline in participation in the labour market in this country since COVID. The question is, how good a read are we getting? Because we've only really got one read on that. Whereas for things like unemployment, we can put together lots of things and try and come up with several reads and see if they're consistent. For participation, we've only got one read. So is the supply side getting a bit tighter because participation's gone down? There's a lot of movement in the population numbers going on at the moment, both past and future. So we've got a tricky task at the moment on that front, and we have to keep coming back to this subject.
I actually want to go back to the language, because I think you were pretty clear last year when you said gradual and careful for you is roughly quarterly cuts, and so the market has believed you.
Yeah.
But to what extent is there disagreement within the committee, and exactly what is meant by gradual and careful?
Well, we've also said that we're not on a preset path. So we've always been very clear that although we actually, yes, we have cut on each quarter for a year now, it's not preset. And the point I would make today, I think it's an important moment in time for this, is to say, I think any confidence around that path at the moment, for the reason I said earlier about uncertainty, I think it is less clear at the moment what the path will be immediately, even though I think we're on a downward course.
So do you think you'll have to reappraise that language of gradual and careful? I mean, you changed some language when it came to restrictiveness of rates going forward.
Yeah, I think it's appropriate language for the moment. I think it's important, though, that we have this second piece of language always there, which is no preset path. And I think I would say, I think the message that we're giving today, if you want me to sum it up in one sentence, is this is now more finely balanced.
Lower interest rates will come as welcome relief for the UK's mortgage holders. I took a closer look at the outlook for the housing market in London and the impact of government policy changes. House prices in the UK are falling as higher taxes hit both domestic first-time buyers and international non-doms. In July, average house asking prices fell by the most recorded in 20 years, according to Rightmove, and London was the most impacted. Asking prices from new sellers fell 1.5% compared to the month prior, and in inner London, like here in Hackney, they fell 2%. While house prices do typically fall in the summer period, Rightmove says that this time is different as the rise in April stamp duty hit buyer affordability. This has been most acute in London.
So there was a stamp duty holiday that came to an end at the end of March. And what we can really clearly see was happening in our data in terms of London was that Londoners got really active during the end of 2024 and the beginning of 2025. So in effect, they moved forward a lot of their moving plans. And so we saw a lot of that activity front-loaded into 2025. And now what we're seeing is a bit of a rebalancing of that peak. And it was really affecting London more than the rest of the nation, simply because of how expensive homes are in London.
This factor, alongside the return of sellers who delayed moves due to market uncertainty, has left a glut of houses for sale in London.
We've seen a decade-high level of available properties for sale. And that means that sellers are having to price more realistically in order to attract buyers.
Changes to non-dom tax rules and uncertainty surrounding future tax changes are also likely to affect the housing market in the capital.
What we're hearing from agents who are operating in the prime central London market is the non-dom tax rules are having an effect on buyers. And we can see that in some of those more expensive areas, demand from buyers has dropped.
Still, mortgage rates are continuing to fall, and investors are anticipating more interest rate cuts by the Bank of England this year. This means the outlook for the housing market in the second half of the year may improve, according to Knight Frank.
I think it all comes down to affordability. If the Bank of England cuts rates more aggressively than some believe they will this year, then that will have a knock-on effect to mortgage rates. Affordability is at a high compared to where we were in 2022. Mortgage rates are lower than they were. They're not where we'd like them to be. But if we can see affordability to continue to improve, and house prices are obviously not rising at the moment, so that will help, we could see a situation where more offers come through, the property market normalises, and then it will be less of a buyer's market and there'll be more parity between sellers and buyers.
One area of London that is making a comeback is Canary Wharf. Following the pandemic, the rise in remote work led many to predict the demise of the financial district's prime real estate status. That is now changing as work-from-home policies are subject to increasing scrutiny by UK employers. So is this the first time you're coming to these events?
Yep. It's my first time coming to this Wharf Connect event. I have never been to it, so I didn't expect much, but this exceeded my expectations.
Canary Wharf holds events like dumpling making to bring people together within the first 10 years of their career so that they can network and meet new people. And well, it looks like a success. It's a full house. Since COVID, obviously we've seen a lot of people who are working from home. Events like this, you think bringing them back to the office?
Absolutely. I mean, I think the more that people can find ways to connect with others, make new friends, and also the more positive experiences you have doing that, maybe my day-to-day will be more interesting.
Despite the death of the office rumours that circulated during the height of the pandemic, it looks like businesses are raring to get back to the workplace. Property giant British Land says that midweek occupancy in central London offices have returned to pre-pandemic levels. Meanwhile, Canary Wharf scored a recent victory when HSBC reversed its decision to leave the area after realising it needed more desks for returning workers. The CFO of Canary Wharf says return to office rates are improving.
Post-COVID, as people have gained confidence again that it's safe to come to the office, that it's a great environment, we're seeing more and more people come back to the office. Indeed, last year was our highest footfall ever at Canary Wharf, 72 million visits last year, and we're seeing this year exceeding that. But from businesses specifically, we're hearing that they want their staff back to the office, that it's really important for connection.
Despite media reports suggesting a great return to workplaces, researchers at King's College London found that work-from-home rates have remained stable since 2022. But Brian Elliott, CEO of think tank Work Forward, says even if companies are mandating a full return to office, not everybody is complying with what their bosses are asking for.
So from a 5-day-a-week perspective, we're not seeing that happen very broadly. In a lot of organizations, the CEO may be asking for it, but managers are then stuck in a hard place. So think about it the following way. We're all under more pressure to do more with less, the third year of efficiency that we've got going on here at the same time. If I'm a manager with a team of people and they're coming in 3 days a week, but their performance is really good, I'm very unlikely to fire them simply for not obeying a policy about the number of days a week coming into the office.
King's College London research also reveals that less than half of UK workers would comply with a full-time return to office mandate. Brian says that something in the middle may be the optimal solution.
There has yet to be a good academic study that actually shows that 5 days a week in the office is better for much of anything. A study that got published in Nature last year that showed that hybrid organizations had the same productivity or better than those that are 5 days a week in the office, but also had a big benefit of employee retention, so much lower costs of turnover.
So far, few of the big banks operating in London are requiring a 5-day return to office requirement, with the notable exception of JP Chase. Barclays and Lloyds have implemented a minimum attendance of 3 days a week, while HSBC is contemplating doing the same. More than 200 landlords have poured their final pints in the first half of the year as businesses grapple with changes to the April budget. I take a closer look at Britain's hospitality sector and how pubs have been coping with higher costs. The pub is a central part of British culture, social life and the economy. Here at the Devonshire Arms, it's business as usual. But sadly, you don't have to walk too far to see boarded up pubs, as trouble brews in the industry. More than 200 pubs in the UK closed in the first half of the year, official government figures show. That amounts to 8 pubs a week, with London experiencing a significant number of these closures. This comes amid a challenging backdrop for the industry, with increases to the national minimum wage, national insurance contributions, and business rates payments. Pubs and breweries are amongst the most heavily taxed business sectors in the UK. The Devonshire Arms is a quintessential example of a British pub with roots back to the 18th century. But like many other pubs in the area, the rising costs have been passed on to the consumer, with the average price of a pint of beer now around £5. Tim Skinner, manager at the Devonshire Arms, is grappling with the changes.
It's 3 big increases all coming in at exactly the same time in the April budget. So obviously there's been a lot of cost increases in any case, in energy and operating costs over the last few years, but the national insurance increased directly, the business rates increased directly, and obviously maintaining the level of VAT where it is means that a business like this needs to find around £30,000 extra a year just to stay still, so it's a big impact.
So these higher costs that you're facing, are you having to pass them on to the customers?
We are, of course, but it is a little bit of both. So we're having to pass some of those costs on to the customers, but we're very mindful of where we sit in the marketplace. It is still very competitive and we're having to fight for every pound that the customer is willing to spend. So we're trying to make savings where we can, but we're running out of opportunities to do that.
With the industry in decline and numerous closures, British Beer and Pub Association spokesperson Charlie Hall says the knock-on effects to the economy will be significant.
From grain to glass, our sector supports over £30 billion being pushed into the economy, £18 billion in taxes, 1 million jobs. And you can imagine when you've got one pub set to close every week this year, that does have a massive impact on the supply chain, everything from hop farmers, to glass manufacturers.
There are wider calls from the industry for the government to deliver changes in the upcoming autumn budget. Mick Howard, Operations Director of Star Pubs, highlights a need to reform business rates, cut beer duty and avoid any further rises in national insurance contributions.
Investing in tax relief, investing in some of the support pubs need is an investment in those communities, is an investment in jobs and is an investment in sort of further taxes going into the exchequer. We'd like to see the promised business rates reform. Pubs massively overburdened on their contribution on business rates.
If nothing is done, Mick says more pubs will have to close their doors.
We know that the consumers are still going to pubs. They might go to pubs at different times now. They might go to pubs for different reasons, but they still go and visit their local pub. But without that support, if the cost's still going up, the pubs just won't be able to open the doors.
Thanks for watching this special episode of On Assignment. For CNBC Business News, I'm Ritika Gupta.